Look, we all know the stock market is a little extended here, so in this video, I'm going to show you a cheap way to get some bearish exposure over the next 28 days trading options on SPX, and we're starting right now. Let's take a look at some SPX levels. I got a little bit of concern that we could actually pull back over the next couple of weeks. Not that much. I don't think it's going to be a crash or anything, but there are a couple things that I'll show you here in a second. But what we're currently pressing new all-time highs. We do have some potential trend line resistance up here, and I'm going to call it 4,200-ish, between 4,200 and 4,250. We're trading at 4,189, and we have consolidated here. So for us to keep moving higher would totally be okay. I know it seems kind of crazy, but at the same time, I want to show you the seasonality chart by week. So since 2011, each week of the year, this is showing the percent that it was higher. And we can see that seasonally from a weekly basis, the next 2 weeks, this is the week we're in right now, the next 2 weeks are potentially not going to be positive, right? So, what we could very well see is if the market goes up, I would really expect some kind of pullback. That doesn't mean it's a crash. It just means that the week is negative, meaning the week closed lower than it opened. So again, there could be, and maybe that coincides with earnings season and earnings season starting to wrap up. We could be getting, a push up from earnings and then some profit taking. So what I want to do is, since I'm running, several bull spreads in various forms, is I want to get a little bit of protection to the downside. And so what I'm looking at just some basic levels here. I'm okay if it coming down to the 41.26. I don't need really a lot of protection there. But if it gets below that, I want to have some protection around the 4100 to 4050 area. So a cheap way to do this, I just put this on myself, is I went out to the May 24th expiration. That's about 28 days. So that's about a month. That gives me, a week. Let's say the market stays flat this week, and then let's say we trade sideways or pull back over the next 2 weeks. This gives me enough time to cover the next few weeks. And I went out and bought a cheap butterfly spread in SPX. I bought the 440 call. I sold 2 of the 4070 calls, and I bought a 4100 call. And what this is going to do for me is it only costs $100, $105. And if the market does pull back and ends up in the zone, you can see the payout would be huge. I'm not really expecting this huge payout, but the idea is to get some negative deltas. We can see that this orange line is the T line or delta line. So right now, if the market does pull back, this trade will actually start to make a little bit of money. Doesn't mean it's going to make that much money. It's actually very low probability. I think the probability of profit here is like 20% or something. It's not a high probability trade, but it's cheap to where if the market does not pull back, it's not going to affect the income of all the bull plays I have on, but it actually gives me a little bit of protection in case the market does pull back. And if we get a more significant pullback, this trade makes money between 40 basically and 4100. That's a 60-point range. That's the basically the width of the spread. So if we go back to the chart, this is the profit zone on SPX right now, and this would provide a lot of protection if the market simply pulled back, let's call it 100 points, right? So that's what I'm trading. We'll see you guys in the next video.